Puglisi, President and Founder of Cybertrain University. Want to do a quick audio check? Can everyone hear me loud and clear? Just give me a chat in the questions box. All right, perfect, perfect. All right, well, welcome back on Closing Bell, ladies and gentlemen. What we do here every Tuesday, we always bring in our channel partners, our featured guests, people that I feel that will help benefit you and your education needs regarding about trading, and most importantly, great contributors in the educational market and trading. And we have a very good special guest today, Todd Gordon, very, very good friend of mine for a very long time. You've seen him probably many of times on CNBC. He's appeared on Fast Money many of times, Squawk Box. He's been on the street. I mean, endless. It goes to Futures Now, Street Signs. He's got a very, very good money show. You've probably seen doing some speakings there many of times. Probably most famous seeing him on Fast Money and Squawk Box. But Todd's been a very, very close friend of mine. Been around for a long, long time regarding about trading in the markets. I know Todd for several years now, and I always like to bring in great guests that are great contributors to the education part. And Todd always never really has as much time as he would like when he's online, when he's doing his broadcasts on TV. But here's a great opportunity to spend a good hour with him so he can explain things in great, great detail. And his topic, what he's going to be talking about, which you can see on the screen, is what every trader out there needs to know about trading with Fibonacci. And he's a very, very good forex trader regarding it also. So he has a lot to cover. He has a lot of great content. We're just happy to have him here. So I don't want to take too much time with him. This is being recorded for your listening pleasure. It will be broadcasted on our YouTube channel, and you can listen to it later or pass to your friends and can follow Todd down the road and obviously join anything he has to offer regarding at the end of the presentation. So try to keep your questions very limited. He's very limited with time with the hour, so he'll try to teach as much as he can within his time frame. So without further ado, I want to pass the mic over to Todd. Everyone enjoy the presentation, and thanks for coming on Closing Bell.
Hey, thanks very much, Fausto, and it's nice to be finally working with you and the team. Fausto and I have been friends for probably coming up on 10 years. We've actually never done anything in an official capacity together. We've always been friends, so seems to go that seems to be the way with a lot of people around our industry. So nice to be finally do something in official capacity, and hopefully have something to share with you guys. So thanks again, and I appreciate keeping questions to a minimum, but I'm pretty streamlined in this presentation, so if it's something that's relevant to the current slide or the topic, go ahead and throw it in there. I'll try to address it quickly. If not, then I'll definitely do it at the end. Okay, so let's dive in. Again, what every trader ought to know about trading with Fib, and there's a lot of misconceptions out there. I think along with this misconception has been a lot more interest in Fib. I'm seeing a lot more educators out there and professional traders start to use Fib, and it's something I've used ever since I was about 20, 21 years old when I really first started trading. So we're going to try to show you some of the value that trading with Fib has to offer, try to debunk some myths, and maybe get you to look at it in a little different way. So to start, generally I do find some skepticism with Fib, and generally I find about 61.8% of the people out there find that it works, and 38.2% of the people don't. Sorry, bad joke to start, and if you don't know anything about Fib, those are Fib ratios. If you do know something about Fib, you're probably rolling your eyes. The other bad joke I have is I set my alarm generally at 6:18 in the morning, which is an even worse joke because it's not true, because we just had a pretty important little technical pattern in the market happen in this house. It's you guys might recognize it. It's a little double head and shoulders pattern here. Double head and shoulders, little breakdown, and what turned into twin boys in the house. So our twins are going to be 1 year old next week, and believe it or not, guys, their birthday's on Friday the 13th, and they're going to be 1 year old. So double trouble came to town, and what are the chances of your first birthday on Friday the 13th? So good sign? I don't know. So that's me. I run my trading business out of my office here. That was the picture of my office down there in the first screen. And I'll tell you a little bit about what I do, but most importantly, I want to talk about some chart patterns. So we got to do some warnings here. Oh, thanks, Lori. Appreciate that. Thanks, guys. Real kind of you. we got to do the warning, of course. We've got to do the disclosure. This representation is, this strategy and what I'm talking about can put your trading capital at risk. And, we want to be sure that you are fully aware there's danger in everything we do in trading. You only should be trading with capital that you can afford to lose because, guys, you're probably going to get beat up a few times. You're with Fausto, who's going to take really good care of you and put you guys on the right track, but things can happen. So be very careful in trading, and it's very important to take responsibility. And I think the best thing you can do with that is to kind of trade by my slogan, the slogan of my company, which you've heard before, but I really adopted in the logo of my company, which is plan your trade, trade your plan. And I think setting up with Fibonacci helps you get a little bit ahead of the market. And let me turn that down a little bit. Helps you get ahead of the market a little bit and begin to start to anticipate rather than react. Okay? So from there, we are going to bust some myths. All right? Technicals don't work in highly emotional markets. I think we've heard that before, and I think some of you probably agree with that. Type in a yes for me if you don't mind, if you feel that technicals tend to not work on the most volatile markets. If you do believe, why don't you let me know as well? So we want to go and then, okay, I was getting some response there. Well, let me just make some points here for you. Let me make sure I'm not getting yelled at here on Instant Messenger here. So let's take a look at something pretty interesting, 1925 to 1929, the rolling 20s, I think that was what it was called. And then all of a sudden, what happens? Stock market crashes. Uh-oh. What I would notice here, guys, what if we zoom in here a little bit? In the 1929 crash, what do? We sell off right down to this level right here, 618. Okay, and that's a 61% price retracement from the low in 1925 up to 1929. We bounce, come back, and then we bounce again, and eventually it breaks down. All right, I would say it was a pretty emotional, crazy time, and I guess the markets and traders back in the 1929 crash were looking at the 61% price retracement. I really doubt it. I really don't think they were. I think people were so panicked about the collapse of the economy that they weren't looking at technicals. I don't even know if Fibonacci was used back then. So I'm pretty sure the technicals held extremely well in this crash. Okay? So, guys, a little bit about me, just to give you kind of a taste of what we're going towards. My name's Todd Gordon again. Fausto, did me too much justice in terms of what I've done around the industry. I've been on CNBC quite a bit and got to meet some pretty famous people along the way through, this awesome career that we're involved in. And, I got to meet some fun guys. This is Damon from Shark Tank at CNBC, and I got to meet Cliff Clavin from Cheers. That was pretty fun. He was on one day on Squawk Box. Got to meet him, and Donald Trump was at my wedding. We got married at his club in New Jersey, and my buddies laughed at me saying that I was getting fired here at my own wedding, saying you're out. So it's been fun. I always find that it's great to surround yourself with people who are obviously much smarter and more talented than you are, and that's just what forces you to rise to the next level and become a better professional person. Although that's questionable if you're going to hang with Donald Trump to become a better person, but we can leave that for another time. So anyways, again, I've had some nice fortunes of being on CNBC, been on a bunch of times, and it's funny, guys, I go on CNBC, and I know a lot of people kind of laugh, and the technical traders that we tend to laugh at CNBC a little bit because it's a lot of fundamental stuff, but I've always been the technical guy. They've gone to me for 4 or 5 years now, and I always go with my levels and everything I'm talking about. It's based on my technicals, what I'm going to show you here today. So I never say kind of why or how I came up with those levels, but it's technical based. So, and there's other people on CNBC that do as well. So if you think you don't hear fundamental stuff, you do on CNBC, I can promise you. Zoltan, exactly right. Yep, you got it. That's exactly where it is off of 78. Trump's Club is right over there. Exactly right. So, that's funny, guys. Anyway, I got to stay focused. You guys are funny. Okay, so assumption number one, technicals don't work when markets are highly emotional. We'll look at that. Technicals are self-fulfilling prophecies. Is that true? Maybe. We'll take a look at that. Number 3, I only trade when my indicator issues a clear buy-sell signal. Okay, I like that to some degree, but I think we can enhance that a little bit. All right, so let's go back in time. Let's go back to that 1929 crash, and let's see what happened after the crash. Okay, so we held that 618 level. That was the level back there. We rallied back. We tested that level, sold off, rallied up, and these wound up being the 50% retracement, 38% retracement, and then the crash continued. So we held the 618 way back here, then we rallied up to the 38% and the 50%, and then sold off. So again, I don't know if people are looking at fib retracement levels on a possible backup of the American economy from destruction. Okay, so let's keep going forward. 1929 top, those 2 little fib retracements I scrunched up right here. We continue to decline for a long time. A lot of people don't know that, how long the crash actually took. So we get down to a Dow Jones Industrial Average of 40.56. Imagine the Dow being at 40. That was July 1932. Then we rally back. Okay. We rally up to 194 in the Dow, and then look what we do again. 618 to 618, and then we're off and running. So guys, I basically have showed you almost 2 to 3 of the 4 significant turning points in the market were captured by one of the 3 Fibonacci ratios that we're going to work with. So, is it only working back in the 20s? No. Here's the 1987 crash. We sold off 1987 to the 38% of the blue line, and we sold off to the 50% of the red line, down into 1616, which is that October 1987 low. We held, and then we were off to the races. Okay, so that's kind of a zoomed-in look at that. So then you can say, all right, well, does it only work in crashes? 1929 and 1987 crash? Nope. How about from 1987 low up to 2000? All of a sudden, that 2002, when Bernie Evers goes to jail and WorldCom and Enron and all that fun stuff, I was day trading stocks at those days. I remember there was massive volatility in there. So if we do a swing from 1987 up, and then from 1994 bull market, you have the 50% of 618 retracement, right? So those are pretty extreme market events that I think were probably the most emotional, volatile events that we've seen, and Fib did hold. Okay, and I know what you're thinking here, guys. You're cherry picking the levels. Okay, where do you start and stop the Fib ratios? And everyone asks that. So it's a very valid question, and I think I have a way that I teach my customers and my subscribers to get you to objectively identify how to put those Fib retracement levels on, and where to start them and where to stop them. That's the most important part. Okay, so Fib, I kind of use the analogy that when I'm thinking when Jake and Brody are older and we're driving to Las Vegas, or maybe we're walking in Vegas and we want to start here. Let's say we want to walk up to go shopping at the Wynn, and they're like, "Daddy, how long is it going to take to get there?" And I look at the map. I'm like, "Yeah, it looks like a couple blocks, right?" But then if you've walked around in Vegas, you don't realize just how big it is. Like a couple blocks in Vegas can take you 3 hours to get there. What you're missing here is you're missing this little scale to tell you how long each road is, and that's going to equate to how much walking distance there'll be. So Fib is really this little key here of the map. It should tell you how long the journey should take. And to be a pre-planned trader and to really kind of try to eliminate as many unforeseen obstacles and variables as you can, planning the journey and planning how long the trade should last, I think is an imperative part. It's not always going to work, but if you have a plan, you're going in cool, calm, collected, and ready to fire. Joe, don't worry, man. I'm going to get there. I promise you. I'm going to send you away with a very objective way, and not only I'm going to show you. Don't worry. Okay. So myth number 2, we got to bust some myths first. We got to do the build-up. So technicals are self-fulfilling prophecy, no problem. So I couldn't do this justice. John Murphy, who's really, I think, the grandfather of technical analysis, he was the technical analyst on CNBC in the 80s and 90s, even before it was CNBC, when it was FNN. And then I've been lucky enough to serve as a technical analyst from 2008 on. It's me and really a handful of other guys that go to for the technicals. He does it. He put it very succinctly, and this is a quote right from him. The self-fulfilling prophecy is generally listed as a criticism of charting. It's more appropriate to label it as a compliment, right? After all, any forecasting technique that becomes so popular that begins to influence events have to be pretty darn good. So basically he's saying is if technicals got to the point where they're really starting to impact the course of events in the markets, there must be a reason they're so heavily paid attention to, so they must be important. So is it a self-fulfilling prophecy? To some extent, yes. But I think we showed back in the 1929 crash, the reaction back, the 1987 crash, the 2002 crash. I don't think people were watching Fibonacci retracement levels in the 1929 crash. I don't even think they knew what they were. So are they a self-fulfilling prophecy? To some degree, yes, but for the most part, no. Number 3, I only trade when my indicator issues a clear buy-sell signal. That's science and math. And Albert Einstein, who I would say is probably the most important scientist we have, not just scientist, but he did all kinds of amazing stuff. Physicist, I guess you would say. He has a great quote that I'll show you here, which is basically it's later in the presentation that God does not play dice with the universe. There's an order and there's a pattern to everything. We'll talk about that. But the beauty of trading, in my opinion, is a combination of science and math as well as art and psychology. You got to have an eye. You got to train your eye to look at the charts and look at the markets in the right way. You got to obviously do the math and the science aspect where A plus B equals C, but then there's the psychology aspect too where you got to kind of get behind the charts and get behind the patterns and figure out what the mass psychology is that's driving the market. It's the combination of all three that I think makes trading completely awesome, and that's what it is. So it's science and math, yes. But there's the social sciences that come into trading too, and I think you guys all know what I'm talking about. Okay, so when you guys first started trading, and I think back to when I think it was 18. I was 18 when I first started trading. I opened an E-Trade account with like $3,000, and I think I lost it all. I was day trading stocks on my dial-up modem on AOL, and I remember I got the phone bill. My mom almost killed me. I was home from college. I had like $1,000 phone bill because I was dialing on an AOL long distance to trade. But when you first started trading out, guys, you're probably using the same indicators, right? MACDs, stochastics, a moving average. You're like, damn, I knew there was a reason, I'm losing money. Now you realize because you're using what everyone else uses, right? So if you're doing what everyone else is doing, can we all make money in the markets? Probably not, right? So, if you think about indicators here, let's just kind of watch this chart. All right, this is a Dow Jones, and it's working on a stochastics and MACD. And if you watch what makes these indicators change, it's just price. These indicators cannot change unless price changes, right? As we go down, dip, and this thing is going to reset. I mean, that's all that makes indicators change is price. Okay, so if indicators are reacting to price, and we're using the same indicators that everyone else is using, we might have a hard time making money. Okay, so what I want to do is try to get you guys to think ahead of the market and anticipate price action, right? This is not guaranteed. Okay, you can get ahead of the market, you can have a plan, and I would say 5 out of 10, 6 out of 10 times that plan is going to play out, and the other 4 to 5 times it's not going to play out. But the most important thing is you're obviously risking X to make 2, 3, 4X, right? So that's trading, right? I mean, they don't call hunting killing, right? It's not just go out and kill everything, because sometimes you get something, sometimes you don't. And they don't call fishing catching, right? Because there's a chance, all right? So we're going to take calculated risks that we're going to determine ahead of time to see if we can reap calculated rewards in the market. So let's play this same video. This is the ITB. This is the housing ETF on the 30-minute. And this is an actual trade we did in the service. And this is a little bit of hindsight stuff, but this is an example of how we like to trade. We like to anticipate where we want to be in. So we bought a 25.27 called debit spread in the ITB, which is the housing ETF, I believe. That's an actual trade we just did last month. But you noticed, I mean, we anticipated where you want to be in the trade. Okay, here's another one. McDonald's, this is another trade. We were anticipating that 97.99 resistance zone. We got short right in that zone. We did a 95.90 put debit spread. We like to trade options. And it went right down into our take profit. So does it happen like this every time? Of course not. Okay, of course not. Some work, some don't. But the most important thing is we're anticipating where we want to be in the market. And when you're anticipating where you want to be in, I mean, it's a very liberating way to trade. Okay, you don't have to be chained to the markets all day. I mean, I started off as a day trader in San Diego, banging 50, 100 trades a day, scalping for nickels and dimes. You know, I like to swing trade now. I put on positions. You know, I like to have 4, 5, 6 trades a week, and that's about it. And that's how we try to trade. I know Fausto is much more active. I guess I'm a little bit more lazy. I guess I don't know. So here it is. Einstein, God does not play dice with the universe. All he's saying is there's a pattern. There is a structure out there. There's a structure to the universe. There's a structure to how people interact on a mass basis. People tend to make the same psychological mistakes, and they tend to exhibit the same characteristics time and time again. And believe it or not, the stock market is the best representation of how humans on a whole are doing. Right? When we're all doing pretty well, stocks are higher. When we're all fighting and killing each other, stocks generally go pretty low. And basically, what Einstein is saying, there's a pattern to the universe, and there's a pattern to how humans interact, which means there is patterns in humans' report card, which is the stock market. I know it's pretty crazy stuff. I mean, I know it's out there. I mean, I get up every morning and I can't wait to see, you know, how the market's responded to levels that are laid out overnight, and I still can't believe this stuff works. And I'm 36. I've been doing it since I was really 18, 19 years old, so half my life. It's pretty crazy. I can't believe that this stuff works, but it does. Okay, so I kind of jumped ahead on that slide, but you got my point there. The Fib ratio we're going to look at is 618, and it's going to help us to understand seemingly random occurrences such as social progress. Okay, social progress, market performance, not random. All right, we've covered that at length. So let's keep going. 618, you know, you get the point. You've probably seen the math before. I'm happy to send you the PowerPoint later on if you want the numbers, but I'm not going to waste any time on it. The real number we want to look at here is the 618 retracement, and everything we're working with, all the Fib levels we're looking at are based on 618 or 1.618 one way or the other. Okay, so this is one that's important, and then one that people don't often understand or use is this one, 786 and 1272. Those are really powerful ratios that you need to be using, and if you're not familiar with them, get familiar. They're really, really valuable. So we'll talk about those. Okay, so to start, I promise you guys we're going to figure out how to anticipate swing waves. All right. A swing wave, this is how you're going to begin calculating where to start and stop Fib, because that is the most, if you're not familiar with it, Fib can be very ambiguous and to say, where do you put your ratios, and I totally understand. So a swing wave is a low or a high in a chart where price reverses trend. Okay, swing wave high, the current high has a lower high before and after the bar. So if it's swing wave high, we have a lower high left, lower high right. Very simple. Okay, swing wave low, same deal. We have a low bar, but we have a higher bar left and a higher bar right. That is simply a market swing. You guys probably all know that. Okay, so let's just hammer this one home. Swing wave high, got a high bar, and then a low bar right, low bar left. This is Apple Daily. We've got a swing high here, low bar left, low bar right. This is actually a swing high. I didn't label it this one. High, and then maybe that's actually real close. We've got to see what that high is. That's definitely a swing high. That's a high. This one actually is as well, because you have a high bar right, high bar left, and then obviously the one I've labeled is as well as that one. Okay, let's go to swing bar low, swing wave low. Same chart, Apple, you got a low there, got a low there. That's one I didn't label, but that's one, that's one, that's one, that's one. Okay, so those are just simple swing waves. All right, and that's Apple with all of them labeled. And I don't think I left anything out. There should be all swing waves labeled on that chart. So great. What do you do with that? Okay, you got to break it down into major and minor. By understanding your major and minor swing waves, this is how you start calculating where fib starts and stops. All right, a minor swing wave is a brief reversal in the trend that is exceeded, in the 5 bars prior and the 5 bars following. A major is a swing wave that is not exceeded in the 5 bars prior, 5 bars following. All right, so let's take a look at that. Here we go. Here's a swing high, right? Low bar left, low bar right. What you do, guys, is you just count 5 bars left and 5 bars right. If there are no higher bars, you have a major swing wave on your hands. So we're going to count 5 left. 1, 2, 3, 4, 5. Good. You're going to go 5 bars right. 1, 2, 3, 4, 5. Good. That is a major swing wave. Minor swing wave. You have a swing wave that is exceeded within 5 bars left, 5 bars right. Okay, so let's go left, or what we call prior. 1, 2, 3, 4, 5. We're good there. Let's go right. 1, 2, 3. Okay. Can you guys see my cursor okay moving on the screen? I hope. Tell me if you can, yes or no. Yes, no, 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 no. Oh, that's not good. Some yes, some no. Oh, that's interesting. What about if I use laser pointer? Does that help? Wow, that's okay, perfect. I'll use laser pointer. All right. Well, I don't think we missed anything yet. Well, that's interesting. I wonder why cursor wouldn't show up. That's fine. Okay, so again, minor swing, but I think you guys are probably cool with this. So we got swing bar high here. 5 left, we're good. And then we start counting 5 to the right. 1, 2, 3. That's no good. So that is a minor swing wave. Okay. Perfect. So here's the same Apple chart, and we have major, minor swing waves labeled. Major in blue, minor in red. So major up here, 5 left, 5 right, you're good. Here we go. This is a minor because you count 5 left, 1, 2, up, no good. That is a major, minor, 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 major. Okay? So you just got to kind of get used to counting and just start rethinking the way you look at swings. And this is going to be an important component to use in your fib. Okay. So we've got swing waves down. Now we're going to dive into 3 tools of fib. Guys, I only have time to show you 1 and kind of 1.5 tools. We're going to do retracements, and I'm going to just introduce you to external retracements. There are 3 tools of fib, and there's actually 5 that I use. But we're just going to do 1.5. Of course, that's all we have time for right now. But trust me, you guys are going to be able to walk away here today. I'm going to make you an offer at the end. Of course, we're going to give you advanced trading, but if this is as far as you go, you will be able to start setting up trades right away. Yeah, Ron, we trade everything. I started off in the currency markets, but now I trade mostly ETFs, stocks, stock options. I trade anything that moves, actually, anything that has a good pattern. Okay, so let's get into retracements. Okay, now just step back a little bit. What is it we're trying to do here in trading? All right. This is, I think, the best summary of all trading is, in my opinion. You want to buy weakness in rising markets and sell strength in falling markets. That's it, right? If it's an uptrend, you want to buy pullbacks. If it's a downtrend, you want to sell little rallies. That's it. Okay, so all we're going to do with the retracements is start to quantify how far those corrections should go before the trend resumes. That's all we're trying to do in trading. And you're trying to get into that correction at the latest possible point you can in the correction before it stops and it goes into a trend, right? And I see a couple questions coming in here. Guys, you can use this on any time frame and any freely traded market, right? The only one I question is the bond market, which I don't know if I think the government has their hand in that one, but conversation for another time. So how do we determine the trend? I think a lot of you could probably eyeball it, and you're used to looking at markets and just determine the trend. But if you want a crutch to lean on at first, I think the 55 EMA is good. Why 55 instead of 50? Well, it's a fib number, of course. All right? So just determine the trend of the market by slope of the 55 EMA. All right, so little Apple here. We're on the Apple train, 3 hour. Obviously, that's an uptrending market, so that is an uptrending EMA, so that's an uptrending market. Over here, this is the XLE Energy ETF. That guy's downtrending, and that's what we're doing. So are we trying to buy pullbacks to this moving average? No. Okay, that's horseshoes and hand grenades. All right, close is not good enough for us. We want to try to figure out exactly how far that correction is going to go before the uptrend resumes. Okay, got to be more precise than that. But it's a good trend indicator, in my opinion. Okay, so let's get into our first example. We're going to start to pull these tools together. Number one, isolate the trend. All right, we have an uptrending market here. This is Apple 3 hour. We got a 55 EMA that's starting to move up. We got an uptrend in Apple. Surprise. You can tell I captured those charts a while ago. All right, wait for the trend to exhaust itself and begin to pull back. What you want to see is the MA to start to flatten out a little bit. All right, you want to see the moving average acknowledge this move, so just flatten out a little bit. Okay, now you want to go to work, identify the most recent major swing wave high. Use that high. Okay, go to the next one. There we go. We had a gap up and then a sell-off. That is the most recent major swing high. Okay, perfect. You then want to go and find the most recent major swing low. If you went through and used my 5-bar left, 5-bar rule, 5-bar left, 5-bar right rule, you would see that this is the most recent major swing low and the most recent major swing high. This is how you calculate your fib retracements right here. Okay. So let's keep going in this example. We got major swing low, major swing high, perfect. Use your fib tool. You want to click, most charting packages will do it this way, and fib retracements are available in almost everything now. I mean, almost every charting package out there. It doesn't matter if it's free or whatever it is. So you want to click, for the most part, most charting packages, you want to click your swing wave low first, then go up to your swing wave high. Then all your retracement levels will unfold. Okay, so you want to click the earlier, actually, that's actually wrong. You want to click, no, that's right, the earlier swing wave, which is the furthest left, than the latter one. Okay, perfect. All right, you want to then monitor the pullback levels, looking for swing waves against your retracement levels. Here's the next question they get all the time. Well, how do you know which fib retracement level we're going to use? And if you're thinking that, I love it, right? Exactly. Okay. Here's how you figure out which retracement level to use, because there's a lot of them. Entries only occur after you have a 3-wave swing. You want to see a short-term downtrend with 3 swings. You want to see a swing wave low, swing wave high, followed by a swing wave low to new highs. So here we go. Apple up at the highs, that's that major swing wave we looked at. Swing wave low, a swing wave high, followed by swing wave low. Only after you have calculated that, you see a push to new lows. After a good 3-wave move, you can then go to work starting to buy the market. Okay, so now we're not going to get into money management yet, and I'm going to show you exactly how to enter and exit the market based on a stop as well as a take profit. But let's do another example now based on crude. We're going to go on the short side. Short side in crude is down. EMA is pointing down. You're going to wait for the trend to exhaust itself and begin to pull back. So 55 EMA down, begin to flatten out a little bit. Identify the most recent major swing wave low as well as the most recent major swing wave high. So there's your high, there's your low. For downtrending markets, obviously you want to find the high first and then go down to the low. Okay, because you're going to be looking for a bounce back against the trend, expecting trend continuation, which is on the downside. All right, so there's a couple arrows there, as if I didn't make it obvious enough already. Swing wave high, swing wave low. Okay, perfect. And you always want to use the lowest, in the case of shorts, always the lowest swing wave low. In the case of longs, always the highest swing wave high. Okay, so we're good there. Use your tool. You want to click the earlier swing wave high first, then click the swing wave low next. It's going to lay out your fib retracements. Monitor the pullback looking for swing waves against your retracement levels. These serve as entries. Entries occur only after a three-wave swing. A swing wave high, up. You then want to see a swing wave low. This should go to a higher low. I don't like to see this make a new low, because if you think about it, if this guy makes a new low, the trend hasn't really stopped yet. If the market made a new low, then this isn't part of a correction, really. You know, the market's still downtrending. So you want to see a higher low, followed by a push to new highs above the prior swing. Now you have a good three-wave swing, and when it coincides with one of your retracement levels that we outlined earlier on the slide, you can then begin to looking to establish trades. Okay. Yeah, Ron, exactly. Never a lower low. ABC, Alex, you nailed it. Exactly right. You guys are right on my page. That's great. So A, B, C, swing wave high, swing wave low, but again, I want to see a higher low followed by a higher high compared to the old swing. You have a three-wave swing. When you move into a fib retracement level, now it's party on. Okay, so that's where fib retracements stop. And now we're going to go into money management, right? It's not how much money you make, it's how much you keep. We can all make money in markets, right? We've all put on winning trades, but we've all also put on massive losing trades. And the best way to become a better trader, guys, is to not learn how to make more on profits. It's to learn how to lose less on your losing trades. And that's what I've worked at. I've traded for a hedge fund. I've traded for a $100 million hedge fund. I've traded my own account, blah, 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 enough. I know you guys don't care about me, and I'll stop. My whole point is I've worked my entire career to get the average size of my losers smaller and smaller. And I drop by like such small increments. I'm always trying to push those losers to get smaller and smaller. To stay with a winning trade is something that takes you a lifetime. But you can always improve your trading by keeping your losers smaller and working towards getting smaller losers. That's how you improve as a trader. And you can do it very quickly by working on losing less. So, all right, so we're going to handle all three here: entry, stop loss placement, book initial profits, stop, trail, action plan. We have everything set up for you. Okay, here's the complete 9-step plan. Hope you all are sitting down. No, I'm just kidding. We're going to take you through each one of these. Don't worry. But that's the plan. This is how we're going to tackle it. Okay. After a after a three-wave swing, okay, look for the first minor swing wave low. So we have a three-wave move down. Perfect. So we got a swing wave low, swing wave high, swing wave low. Okay. What I'm doing here is I'm zooming in. Let me go back. I'm going to zoom in on these I don't know, 8 or 10 bars right here. What you want to do is enter long on a move above the low bar. So this was your final swing wave low that said, okay, I got a three-wave swing. Once you move above that bar, that is your long signal. Now, this is an interesting, probably a bad pattern or example that I picked out because we actually did a double top. So it's very possible you were entered, triggered here. You got to look at, was a high made? You got to put a buy stop 1 penny, 1 tick, 1 pip, anything right above the high. So you might have been triggered there, but as we go into stops, you will not have been stopped out, but you will definitely be triggered right there. Okay? You're going to place a stop a few ticks, cents, pips, what am I missing? I guess that's it. Ticks, pips, cents below the low of that bar. Okay? You're going to go below the low of this swing. All right? So you're going to go just below the low here, and you're longish here. You now have a defined risk trade. If your trade is correct, guys, and let me just try something here. All right, let me just do this real quick. White screen. Okay. Let me just get my pen here. If you think the market's in an uptrend, all right, and now you say, okay, the trend of this market's up. I think we're going to do a three-wave retracement into one of the retracement levels. Fine. And your plan for the day is my retracement is about over right here. and I'm going to start moving higher. Okay. If your plan says to buy here, and this is the level you think it's going to move higher, I do not want to see the market move to new lows. If it is, your trade plan is incorrect, and you need to stop yourself out of that trade. So you want to be in, and the only way I want to make money in this trade is if it follows my plan and we begin to move higher. If it moves below, your stop loss needs to go out. Your plan is wrong. Stop out of the trade. Step back. Don't fight. Don't revenge trade the market. Get out. Okay? Remember, keep those stops small, and the only way you can get small is by being very, very steadfast to your stop loss. Okay. So back to 3, place to stop a few ticks, cents, pips below the bar's low. If stopped, okay, you can attempt one more entry while above the 78% retracement. 78% is that final retracement right there. And what I'm saying there, guys, is if you're above the 786 retracement, okay, and you move back above, you can take one more entry, all right, only after you have another 3-wave swing. Basically what I'm saying here is, and I don't have an example, let's say we move up, but then you get another 3-wave retracement back, you're above the 786, you can take another shot at that trade. You can take up to 2 shots. So, you know, again, if we were to do, I would say this is a valid reentry right here because you had an A, B, C swing. You had a swing high, or swing low, swing high, swing low. You could take another shot and then you'd be in there and that trade would work, okay? So you can take 2 shots. All right, so those are retracements. Okay, you guys cool with that? From here, here's your next fib tool, which is fib extensions. Retracements, guys, measured how far a pullback would go in the course of the uptrend, or how far a little rally would go, corrective rally in the course of the downtrend. So basically it's measuring a corrective wave, okay? It's just measuring the correction. An extension are used to measure how far a 3-wave corrective swing will likely last before the predominant trend resumes. All right? We'll go over that in a sec. Retracements are used to measure how far a correction will last before the trend resumes. Extensions actually measure the 3-wave corrective swing to project how far the next wave in the predominant trend will last. Okay? In English, it's a retracement that travels more than 100%, and I'm sure you're confused. If I was looking at that slide for the first time, I would be confused too. So let's use pictures. I am a very simple picture kind of guy. Extensions. So first, as we started the retracements, use the 55 EMA to get the trend. Got that up. Identify a 3-wave corrective trend against the trend. ABC down. Nice little sweet ABC that actually held the 55 EMA. Move up. You now want to measure the actual 3-wave correction. Okay? In the past, guys, we used the prior trend wave to figure out how far the correction is going to last using retracements. Now what we're going to do is measure the 3-wave correction itself using extensions. So you're going to click the start and end of the 3-wave correction using a retracement tool. You click up here, the beginning of the correction, down to the end of the correction. Once you get past 100% retracement, you're going to get into extension territory. You're going to use the same tool, all right? So if a move goes down and we've not yet retested the highs, it's inside of 100% retracement. So this would be a 68%. So basically, if this was a $10 drop in the NASDAQ, 6 points would be at the 61% retracement, 7.5 points would be up at the 78% retracement, a full 10-point rally would be 100%, and then once you get up to your fib extension territory, that's when you've gone past 100%, and here's where extension territory comes in. This is where you start figuring out where to book profits. Okay? So let's go through this again. We have our 3-wave retracement. This is the gold trade we've been working. You're going to enter long here. You might have been triggered here. If not, you would not have been stopped because we did not make a new low. You definitely would have been entered here. Moves up, goes against you. Okay. Here's where you start booking profits. Oh, sorry, guys. I wish somebody yelled at me on that on the laser pointer. All right. Well, I think you guys got that. I was just on the last slide right here. The 100% is right there at the extensions. Once you go past 100% up to the 1272, then that is more than 100%. So this 618 right here is $6.50, $7, $8 of a $10 decline, up to 100%, and then up to the 1272. Okay, that's one of your fib extensions. Thanks for reminding me. I don't know why that cursor's not showing up. That's weird. Okay, so here is the stop management plan. 3-wave move down. We were maybe entered long here. Just got to see, if that was a high bar. We definitely entered long there. Moved up, went against us. Okay, fine. And now we're starting to move. Here's where you start booking profits. You want to book half profits on this trade at the 786 retracement of your correction. So you do your retracement tool. You click the high, click the low, and then you're going to book half profits at 786. Okay. Then you want to trail stop the entry price or more recent swing wave low, whichever's higher. All right. So if you're long here, your entry is going to be right here. The most recent swing wave low looks to be right here. Okay. So if you move up to this high, take profits. The most recent swing wave low would be right here. So it's actually the same price because you're long right at about 1258 here in gold, right? And the most recent swing wave low is right there. So it's going to be the same thing. So you're going to trail your stop to that level. So you're going to get the stop to break even. If the most recent swing wave low is higher, then you'll have a stop above your entry, so you'll have more profits locked in. Finally, you're going to book the balance of the trade at the 1272. So you're going to book half of the 786. You're not going to worry about 100% because the double tops statistically aren't significant. What is significant is the 1272. Now, if you're somebody who has multiple units, lots, shares, contracts, whatever, you can keep a little bit, maybe like a quarter or a third of the position. But if you're a two-lot trader, be out here. Okay, be out at the 1272. A lot of times, moves that break out to new highs, they don't carry through. We're not in a market that you can trade breakouts. In my opinion, a lot of breakouts fail. And the 1272 extension means a lot of times catches those failed breakouts. So you want to be booking profits there. But again, if you have multiple lots, whatever, keep a piece and then just begin trailing the stop up behind. But you really want to be out at 786, out at 1272. Just to review, that's a $10 move. You're going to be taking profits up in a $7.80 move. Don't worry about the full $10 move. And then up to the $12.50 move, you want to be out. Okay? That's what you're going to be looking for on the way out. Crude oil, okay, let's just take a look at this little example. You want to be trading from a position of strength, right? Chasing momentum is like a dog chasing a car. Eventually, guys, the dog might eventually get the car, but sooner or later, bam, the car's going to stop real fast, the dog's going to get squished, all right? So what you want to do is trade from a position of strength by anticipating entries. Right? If you anticipated the entry right here in crude, fine, you get short maybe on this breakdown, a move below the swing bar low, good. You got to take a market going back against you, which is a little uncomfortable. It goes back, but if you can hang in a little bit, then fine, that's a better position to be in. If you were short down here or down here and you had to take this kind of heat, that's a much more uncomfortable position to be in. You're likely to make bad decisions, right? So anticipate entries. Trade at the upper end of the range rather than trying to trade the breakdowns, which we've all been through many times, right? If you're short down here, that's a much worse experience than waiting for the three-wave correction up here. Okay, you would have been stopped out if your entry was at break even. Okay, this is a bad example because we did spike higher. A lot of times you get short up here, comes down, retest your entry, and then goes. That's a position of power. That's where you want to be. So, guys, a game plan is not chasing price, haphazard stops, or no stop loss. You guys are all in good hands with Fausto, so I'm sure you're not trading with stops. I'm sure you are trading with stops. Trading by the seat of your pants, right? Leading indicators plus anticipated entries plus pre-planned stops equals a game plan. A game plan equals enjoyable, comfortable trading with a repeatable process, which is what we're all here to do. Okay, and you love him, hate him. I think he's great. Tony Robbins. Anticipation equals performance, right? Anticipation is the ultimate power. Losers react, leaders anticipate. And I thought that was such a succinct quote, and it exactly drives home the point that we are trying to make here with this setup with Fibonacci. Okay, so anticipating trade entries right now. We're going to walk through some examples. If you guys want me to look at some charts, let me know. We can do some live stuff. But before we do that, I want to show you guys that we are here to take your trading to the next level. I do want to share with you next step for those of you who are ready to move ahead with us. Obviously I'm very passionate about this. I love doing this. I love getting up in the morning and seeing how the market's filled in overnight, respecting the levels that we laid out ahead of time, getting ahead of the market. So I'm a firm believer that if you use Fib the correct way, you can begin finding better entries and exits. I think we demonstrated that already. Biggest problem is people overcomplicate it, and they're too ambiguous. Like, I don't know where to start and stop Fib. We have a very mechanical way to figure out where to start and stop your retracements as well as take profits. We have, as I said, 5 other Fib tools that we work with, and we have a equally succinct pattern and methodology for trading it. And, I just shared with you one of our many. So it is a little bit more complicated than you're used to, but we can lay out a step-by-step pattern of how exactly to do it. So we're doing a course here coming up in March, the best way to trade Fib. I'm going to share with you how to strengthen Fib retracement levels using, these are the keys here, Fib support, Fib resistance zones, what we call FSZs, FRZs. 1 Fib level is good, 2, 3, 4 is great. Okay, you can stop guessing and risking valuable capital in substandard trade setups. As I said, I am not a very frequent trader. I have been many times in the past, but I'd rather take 1 or 2 quality setups a day than 5 to 10 substandard trades a day, and just hopefully more work than not. Okay, I'd rather kind of sharpshoot the market. It's me, it's my personality. It's not for everybody, but this is how I like to trade. I have a life now. I have kids. I have a business that I have to run. Obviously we do a lot of webinars, and I really enjoy working with people. I hate sitting here by myself, not talking to anyone. It's just not me. It's not Fausto either. So here's what we're going to do. Fraction what you'll learn: how to construct a Fib support resistance zone. My 3 favorite and proven harmonic patterns. Okay, the patterns we're looking at. These are the setups we take a lot in the class. My favorite time frames to trade. I saw a couple people ask, which time frames work. I'm going to show you exactly how to answer that question for yourself. I'll show you how I answer it for myself, but also I'm going to show you how to answer for yourself. Tools that we use, trading rules, Fib tools, how to set up your ratios on your retracements, extensions, projections, expansions. We'll teach you all of it. Checklist, we're going to get a checklist with cheat sheet. I've got over here, I don't have my webcam on, but over here I've got a list of all my patterns that I trade. We'll show you entries, exits, stop loss targets, how to scan the markets, actually scan for these Fib patterns, especially these harmonic patterns. I scan those. So I'll show you how to do that, how to filter out the best trades, and most importantly, take the guesswork out. I mean, I know what the best trades are. Do they all work? No. But I have the confidence to trade the plan through to completion because I know it was a very good pattern. And most importantly, how to avoid head fakes, because there are many markets do try to trick you a little bit. So we will keep you in the best trades. We are going to do a bonus on top of this. We came, pretty prepared for this presentation. So we're going to do a bonus on this. We're going to do 4 live analysis sessions. We're going to do 1 a week. So I want you guys to bring your symbols. Whatever markets you trade and bring them. We'll do the analysis. We're going to do this for 4 weeks, once a week. We'll look at it together. I'll tell you exactly what to do. I might even put the trade on with you. I mean, I trade all day long with clients. Entry, stops, targets, and of course we'll do Q&A. So we're going to do 4 of those sessions. So guys, you do have an opportunity here. Take trading to the next level. If what I've said resonates and makes sense, let's do it. Get rid of poor trade setups. Anticipate the best setups by using the Fib setups that I've introduced to you today. So this is who we're looking for, as I said. Not looking for everybody here. This is not going to be for everyone. I only want to work with people who believe in this or see a lot of potential in this, because I like to make this collaborative. I've got clients in my research business who send me trades, and I mean, they just do great work. So I've taught it many times before, and I love working on the community aspect of it. So we're looking for people who anticipate quality setups, like to find market turning points that others don't see, if you can follow a set of rules. Okay, that's the only thing that I require of you guys, is you can be disciplined and follow a set of rules and directions. If you can't, then this is not going to be for you. And if you believe your trading success is tied to trading only the most quality trade setups, then this is for you. If you're looking to be, bang, bang, bang all day long, looking to trade entertainment, what I call FYE for your entertainment, then this is not for you. You can see valid setups on very short-term charts. Okay, for this style though, this is more of a swing trading methodology. It generally works on trades that last anywhere from a couple hours to a couple days to, if you're super long-term, you can take them on daily and weekly charts. Okay, so this is not for holy grail seekers, guys who trade FYE for your entertainment. We don't trade for entertainment. We trade for money. I can't have you trading from your yacht on the Mediterranean by March, unfortunately, but we can work towards improving where you are now and improving your trading. I can guarantee that. I like people who like to make things more complicated for no reason. We do not need to make things more complicated. Keep it simple. And this is not for people who are kind of humming and hawing and can't move when the process says to move. Okay, we like to be patient, but when the opportunity arises, we move ahead very quickly. Okay, so a fraction of what you'll learn here in the course, as I said, we went through these before. I'm not going to go back over it, but of course we're going to do 100% money-back guarantee. No questions asked. If you don't love it, no problem. I don't want your money. I don't, not to be bothered. I don't need your money. If you hate it, no problem. But I love to work with you guys and as I said, deliver a quality product. So I want to under-promise, over-deliver, which is what we often do. And what you guys can do right now is go to tradinganalysis.com/now, N-O-W. It will fill up. I'm going to show you at the bottom. We are limited. So if you're interested, you've got to go now because it will fill up. So here's what you're going to get. 3 harmonic patterns worth. That's going to be a $97 value. 3 tools of fib. I'm going to show you those. The ART, account risk and trade management. That's my 3-step money management process that we touched on today. The stop trail plan, checklist and cheat sheet, profit taking plan, 4 live sessions, which is more than the total cost of the session. $759 value. Guys, we're doing this for $97. So 25 spots available. If you would like to, please go to tradinganalysis.com/NOW. 27 spots for $97. Okay. Couple FAQs, and I've seen a couple of them pop in there. Absolutely, it will be recorded. You'll have, and look at it, people are calling already. Please, guys, you got to go to the website. Please don't call. Because I don't have the forwarding on to our staff. I think everyone's home. Yes, it will be recorded. We'll have access to everything. Okay. We will. Let me get rid of this. Sorry. You'll have access to the video within a very short period of time, 48 to 72 hours. We'll have that up. Okay. You do not need special software to do this. Most software packages have fib. One-time fee, recurring subscription. It's a one-time fee. You can keep it for 61.8 years. Sorry. What markets will work on? Anything that's freely traded. I don't love doing this on the shortest time frames. Anything from a 5-minute and above, I would say, would be good. And any market's freely traded and liquid. You can do it forex, you can do it in commodities, currencies, stock options, ETFs, bonds, whatever you think. Okay. Yeah, the twins will answer. That's pretty funny. Sure, guys. I'm going to type the link into the box here. Trading analysis /now. Yeah, and what's funny is both twins right now. Oh my God. They're both teething. One has the flu, and the other one can't keep any food down. So it's been pretty ridiculous. So I love coming down here to work to get away from the madness. So anyways, guys, I just put in tradinganalysis /.com, tradinganalysis.com/now. And again, we're going to cut it off here tonight at 25 spots. We can't take too many, so if you're in, please jump in. And if you're not, no problem. We'll catch you next time. Those of you who are jumping in, we will be in contact to get you set up for the March webinar. Now, dates, it's going to start March 4th. We're going to go at 8 p.m. Eastern, and then we'll probably go to, I like to talk, so 3 hours you could expect. We'll have that archive out to you right away. And then we're going to do the live analysis, which will wind up being more teaching, of course, because I'm just not going to beat the same thing home. But we'll do live stuff on the 11th, the 18th, 25th, and the 1st. So it's going to be Wednesday, 10 o'clock. That's the ideal time. Markets open a half hour. Let things shake out, and that's when the volumes really come in. So that is going to be the offer, guys. Again, tradinganalysis.com/NOW. All right, and I'll hang around if you guys want me to look at some markets. We can do that. Any questions? Yeah, we'll definitely have this recorded. I'm sure the team is, and yep, no problem. So again, yes, it does work on all markets. So yep, no problem there. Okay, guys, have any other questions? If not.